Hello and welcome from Seattle, where you can almost smell the coffee. The CFA Institute has been holding its annual Jamboree here this week. It's the world's biggest meeting of big investors, and it's always a great opportunity to take the temperature of how the smart money is thinking. And there have been some big changes since the last time they came to this part of the world to visit Vancouver back in 2008 on the eve of the Lehman crisis. There's a wide sense that the problems that led to that crisis have still not been fixed, and there's widespread anger that bankers have largely managed to get away without any punishment. What are your main prescriptions for what we need to do to fix this?
Well, much higher capital requirements for banks and institutions in the safety net. We've made some progress there, not nearly enough. You need to make sure the banks aren't borrowing too much, but you need to make sure that those who are borrowing from banks are not over-leveraged as well. We need better oversight of derivatives, more transparency. I argue for banning speculative use of the credit default swap instrument. I think it's gambling, so I would ban speculative use of CDS, only let it be used as insurance where the purchaser of the protection has insurable interest.
There's also growing concern about pensions. One of the problems with the very low bond yields we've had for the last 5 years is that they make it much harder to fund pension liabilities. Now the move is on to be far simpler, to try to make sure simply that pension funds can meet those promises to their pensioners.
The pension crisis that we face in America and throughout the world is a cost crisis, a contribution cost crisis. If asset growth does not equal or exceed liability growth in dollars, you have to put up more money. It's called a contribution.
Right.
And here's an example of it, that NYSER's New York City Employee Retirement System had to increase its contribution cost from $68 million in 2010 to over $3 billion last year.
I should also add that the rally in stock markets, 5 years old now, doesn't seem to have made anyone very happy. There's still great concern that stocks are overvalued. As for how people should go about managing money, 6 years ago the debate was still raging over market efficiency. Nassim Taleb, author of The Black Swan, came and talked to the CFAs in a very heated debate. Now, market efficiency seems plainly to have lost. This conference was dominated by behavioral finance and ways to make money from it.
Nobody believes in perfect market efficiency, but there are some behavioral biases, there are some inefficiencies, that I think there are some bubbles. I think the biggest takeaway we have is there is actually a unity in recommendation from all these camps that the whole world doesn't have to agree with, but among the people we're talking about, I think the takeaway is there are ways to, quote, beat the market, but it should be done at a fair fee and with modesty.
The new motto seems to be keep it simple, stupid. Back in Vancouver, and certainly the year before in New York, all the presentations were full of Greek letters and clever ways to use derivatives. Now it's about staying simple and trying to beat the market using new behavioral research.
You look at their behavior. How are they going about it? And the three things are
Not their performance, right?
Not their performance. Performance is not predictive, but their behavior. Are they following a narrowly defined strategy? Are they pursuing it consistently? And are they taking high conviction positions? And we happen to have objective measures of all of those, but that's the key.
But the industry still has to deal with the stratospheric growth of passive index funds, which have been hugely successful post-crisis. That means the attempt is on to find smart beta, funds that tweak the index and try to beat it without spending too much in costs. Many are excited about this. Others suggest they are merely finding market anomalies that will soon be exploited away.
You can always find something that would have worked in the past if you torture the data long enough and hard enough. The question is, will it work in the future? And I think there you should be skeptical.
And as for fees, they need to come down, particularly for hedge funds. Investors are much more cynical these days.
I mean, it's appalling. The problem is that investors very rarely negotiate fees, because the nature of picking hedge funds is you select the hedge fund that you want based on all of the criteria, and fees are the last thing that you negotiate. So the investor's never in a strong position to negotiate lower fees when they basically said, this is the hedge fund that I want to include. But yes, I did the analysis on that, and anybody can sort of tease the fees out from the performance. Once you know the AUM numbers for the industry and the returns, you can derive what the fees have been. And in fact, hedge funds have been fantastically profitable, It's just that those profits have almost entirely stayed within the hedge fund industry of managers and fund of funds.
So this is a chastened and changed industry since the CFAs last came to the Pacific Northwest in 2008. They've woken up, and perhaps in Seattle, they've even smelt the coffee. This is John Authers reporting from Seattle, Washington for the Financial Times.